we see near-term great opportunity, but be careful not to extrapolate out near-term exponential growth in revenues and earnings profile to infinity, because that's more unlikely to occur. And I think we're not there yet as far as the irrational exuberance, but we're getting close. It's almost a risk factor now as much of it is an opportunity. I want to make sure that some standard company isn't falling behind on some area that's going to deteriorate their operating margins significantly and suddenly lead to an outcome I don't expect. I went around the investment committee the other day that we run and took a vote of who thinks one of the Mag 7 won't exist in 10 years. And nobody voted yes. But I would tell you that there's a pretty significant probability by what I just said around the existential nature of the spending. We're going to have the winners and losers still. And the winners may gain quite a lot, right? And they'll likely be in technology in 10 years' time. But we may see an existential problem with a company that you think is an absolute household name and will never go away at this point.
Adrian, welcome back. Thanks for joining us once again on Excess Returns.
Thank you for having me.
At Westwood, you spend a lot of your time thinking about how to build portfolios, balancing capital appreciation, income, and risk management, and managing those strategies through different market environments and periods. And today, what we want to talk to you about was how you're viewing the market and economy today, what maybe you think has changed, how investors should be positioned, and just in general, how you're thinking about portfolio construction across growth, income, and, the possible risks that I think investors should be paying attention to. It's the end of the year. A lot of investors are thinking about next year. We obviously have year-end S&P estimates and market, prognostications happening all around us. So it's always good to have someone like yourself on where we can kind of talk about, I think, some of the basics, but then also some of the ways that the way that you guys look at the markets at Westwood. So looking forward to having a good conversation with you today. Where we wanted, I think, to start was talking about how you sort of have these three buckets when you think about investing: capital appreciation, event risk, and income. So can you walk us through that framework and what that actually means?
Surely. Great question. Thanks for doing your research. We do take our securities and we bucket them out into, as you said, capital appreciation, event risk being that of a company getting taken out in an acquisition or leveraging up in an LBO, and of course, income. And income is usually dividend yield. We've expanded that out a little bit. It's subjective, but really important. And it's important because as an analyst, as a portfolio manager, it gives you a focus on what the real return driver is. Why do I hold the security? Why is this important in our portfolio? Because it's going to add capital appreciation, because the argument in the stock is revenue generation beyond the consensus, and that's going to drive a higher multiple, or effectively just drive a higher stock price as we see realized earnings, or it is that it has a very safe and growing stream of dividends that we like at this point. And so you manage a portfolio on many different spectrum. And one is that, okay, you've got to focus on what's driving your portfolio, but it also says at times in your portfolio, you may see less potential for revenue capture, and you may want to have better on an income stream. And so you can weight your portfolio a little differently. So it's very important to have that part. The event risk, I get excited about the event risk part, and I get excited especially this year when we're cutting red tape and acquisition especially in financial land, for instance, where it used to take you 18 months if you're a large bank to go out and buy a small bank, by which time they've leveraged up. Some of your teams have left. The proposition for why you bought this bank has changed. We're seeing an M&A environment that is changing, certainly, and there's a potential for additional value capture on that metric. So it's something that we use as a subjective, but a really important way to have that discussion with our teams and to keep our eye on the ball of how we're going to make money with our portfolio allocation.
Yeah, so it's not event risk, but maybe event opportunity. To your point about some of this deregulation and red tape being cut. And I think some of the markets are starting to sort of, perk up a little bit because of some of those changes.
Very much so. And I'll add one thing as well that it changes as well on the income variant. These things have significant overlap. I'd like to see an investment that we have capital appreciation plus good income and then get taken out at a 20% premium. That would be the best of all worlds. But in realizing what the real argument in this is, then that helps us identify. But it also, on the income variant, we're starting to do covered calls now on our income opportunity fund. We are reasonably balanced between income, capital appreciation, and downside protection. When we start moving towards, we just launched an income variant ETF or more income focused ETF that is the primary component there. When you add covered calls, it adds a way to take advantage of the capital appreciation by being involved, plus that covered call income. And so it may actually change the scoring you put on something like, for instance, a Google, where if you can take advantage of implied volatility and sell covered calls into the market, you get a 30 basis point dividend yield, but that's not the yield that you're going to get on the position. It's upwards of 6 to 7%. So,
do you think anything has structurally changed in the market or the economy that would support, higher than average returns over time?
That's the big question over the last, since the global financial crisis, or the great financial crisis as some call it. It's over the last about 16 years, less than that, about 14 years, we've averaged 16% returns on the equity market. And when, we put that in my old school paradigm of the usual 8 to 12% paradigm on equity market returns, either something has changed or we're due for a correction. And, one thing I'll say what has changed a little bit. Number one is tech is a higher constituency of the indices than it used to be. This is not the railroad economy. This is a technologically driven economy. Now, can tech keep doing its thing and producing a higher return and an increased multiple as we extrapolate out this excitement and exuberance of future earnings growth? Well, maybe it's an accelerant, unlike I'd say railroads or some of the other industries, energy, as much were. So I could see that we will maintain a higher multiple for some time, but I'd be loath to say that that's going to continue ad infinitum. And I think that's the fear that investors have, and the fear that I have is that, yes, we see near-term great opportunity, but be careful not to extrapolate out near-term exponential growth in revenues and earnings profile to infinity, because that's more unlikely to occur. And I think we're not there yet as far as the irrational exuberance, but we're getting close. So can it continue forever? It's unlikely to, unless we see economic growth be long-term above the trend 2%.
Your gravity is a pretty powerful force still in physics, in the world. So,
Yep.
but I think, to your point on tech though, it is, one, these big, large technology growth companies that have led the market over the past decade plus, they mostly have delivered, from a growth and just overall economic standpoint. So I think that's one thing. And the other thing is, a lot of these companies now are doing more with less real assets and more intangible assets. And I wonder if that plays into like a step up in sort of this valuation that maybe can be a little bit longer, more permanent.
It's a very good point. And we see some of these companies now they're not operating at a 30% gross margin. If you look at NVIDIA, they're operating at a 75% gross margin. And, they are hard assets, but being able to also use intangible assets more efficiently, like Google's got this extraordinary set of intangible assets with value creation. And that's pushing up their gross margins significantly, which means that you could have increased growth over time. You could have an increased moat as well over time.
Although maybe, and this is to the next point, they were doing a lot with intangibles, but now a lot of these companies are also plowing a lot into this big, massive data center, build out, hundreds of billions, if not trillions of dollars, being put into this area. So how do you think about sort of that and and I guess the potential of what needs to happen on the back end in terms of the profits that need to be generated from this massive, build out, and how that kind of impacts the way maybe investors should be looking at some of these companies.
You're right. It's huge, and it's with a T. It's trillions that they're looking at. And maybe best if I get my numbers right of walking through what an example looks like on
Yeah,
this.
that's great.
Until 2030, it's estimated that we're going to spend something like $6 trillion on data center spend, and probably another $2 trillion on AI optimization spend. So call it really $7 to $8 trillion, the numbers they're looking at. And that's increased from recently. If we were looking at something like 5 trillion, it keeps moving up. It's estimated that the global workforce is around $50 trillion in productivity of output. If we see productivity gains from the implementation of technological innovation, like I think we would expect we are going to, just as every day we're using ChatGPT for helping us write things or summarizing a statement, or we're going to find efficiencies. If that productivity gain gives us over 5 years a 20% productivity gain, that's 10 trillion. We're just talking to the global labor force. That's a 10 trillion gain, for which we've then spent, let's call it 7 trillion. Even that I would say is on the conservative side for what we might see from productivity gains. So now you're looking at somewhere between 30 and 40% operating margins that we can get on that. That kind of spells it out for at least where it might come from of if we see that productivity gain as a result of this technological innovation, then it's justifying that amount of spend. If we can do it at even near where the operating margins are on these companies are today. Now, there's all kinds of questions that you want to delve into. Well, where does that money come from? That I don't know, that's $7 trillion. When you look at the book value of equity of the Mag 7, it's around it's a little over $1 trillion. When you look at the private equity universe and the dry powder they have, it's about $2.5 trillion, a little less right now. The venture capital is $300 billion. And the biggest year we've had in IPOs and raising funds, not their valuation and raising funds, has been about $300 billion. So we're still at a pretty like a multi-trillion gap in financing that we can still see that is likely to come through credit in other areas. So yes, I do see it as a potential justification, and our human brains need to look forward to our peers now, which are AI peers, and see the justification or see the benefit that we're going to get in productivity gains. The financing is going to change markets substantially from where we are out till 2030. So that's a big notable item, and it sort of that leads to investable outcomes.
Yeah, it's so interesting because like the value investor in me is like, there's no way, like all this money is being spent. There's no way they're going to be able to get returns on this. But like when you talk to people, I was listening to this podcast with Gavin Baker the other day, and like when you talk to people that are behind the scenes, they're like, when these companies are spending directly on AI, they're producing positive ROI with this. So it's just such a challenge to balance like your thought of this is such a massive number and the gains are so huge, they're gonna have to come with like on an individual basis, like this is producing positive returns.
Yeah, it is. And not to put out a competitor podcast to you guys, but the BG2 podcast does a good, with Jensen Huang and Satya Nadella talks a lot about, they think in 50% margin perspectives, operating margin perspectives. At that, you're still looking at profitable growth for really large amounts of spend if we achieve that productivity gain that we think we will. It's just hard because we as humans, we're used to extrapolating out to the 2026 outlook, like you say. Now we're talking about 2030, and can this continue for an elongated period? How much string do we give this new paradigm to say it might work or not? We do need to see results from companies that are implementing it and finding an optimal solution. And I think we see some of that already. And I look for it consistently. One area is Walmart, for instance. Walmart said they've saved 30 million miles of shipping, 30 million miles of shipping this past year alone in AI-driven optimization of routes. That kind of productivity gain, that kind of operating margin gain for them is a benefit.
Justin, I wish we could be competitive with the BG2 podcast. Bill
I
Gurley
know.
and Brad Gerstner, we're probably a couple levels below that
Appreciate
in our
it.
viewership, but and our tech knowledge. But I wish we could do that. How much do you think about this? Like when you're analyzing any individual investment, like is AI something that's always top of mind now because it's changing the economy so much? Like, are you always thinking about how AI might impact this particular investment?
Good question. Gosh, it's hard not to think about it. And I think it should behoove any investor now to think about not necessarily can they implement it, but are they about to have their lunch eaten by some other company that is natively implementing AI? And that's a distinction that we're starting to see is native versus non-native AI implementation within companies. And that said, we do still look at traditional metrics, and you have to as well, because even if these, if we have a native AI company, meaning they start from scratch with AI, build a product that competes with another product, and suddenly they've got a company that is AI driven, they still have to have customers. They still have to have a fundamental income stream driven by some spend, some efficiency they create for some other company, some business model that downstream is usually driven by real gross domestic product growth, of which 75% of that is consumption. So we're still fundamental investors looking at the same metrics. Yet AI is, it's a question at the top of mind. So I want to make sure that it's almost a risk factor now as much of it is an opportunity. I want to make sure that some standard company isn't falling behind on some area that's going to deteriorate their operating margins significantly and suddenly lead to an outcome I don't expect.
And I wonder how much like the benefit will be to the indirect plays here. If you look at previous things like the internet, the people that built it out didn't necessarily do that well, but the benefits to society were huge, and then it carried down to all the other companies. And so it's just interesting thinking about these builders that are building this versus all the other companies that are going to benefit from it and where that benefit lies.
Yeah, truly. This gets back to the question as well around all this financing, and some would say circular financing that is happening around the market, as with, for instance, Google and not Google with Oracle and Meta, and discussing how they're doing things. Some of these companies have talked about this as existential. So they're spending they're spending because they see opportunity, but also because they have to keep up. And so it spells to me as well, I do have an asymmetric concern of some of these companies just may not, as you say, they may not make it. This may be a great reward and benefit. And certainly it's going to, I'm trying to fix my refrigerator today and I'm asking AI help, some questions around it. It's a benefit to me, but that may not lead to any income for some company that's spending on their CapEx side to try and deploy it.
I'm just curious, beyond fixing your refrigerator, have you seen, like, in terms of your investment process, in terms of thinking about potential investments, like, have you seen benefits from AI in your process and how you operate?
Yeah, we deploy the same investment process consistently, and we really ensure that we have the same mindset, the same steps that we go through to delve into what provides value, the same questions we ask. But does AI provide us with an additional insight? Does it often identify as well things that I might have missed? For sure. I would say people that aren't using AI or eschewing it and saying it's not going to be a part of anything are truly missing out. Now, those also that are saying, I'm going to completely adapt and I'm going to overhaul everything and I'm going to listen to what it says and deploy it, good luck to them. And I look forward to competing against them as well, because human subjectivity still rules the day. But as stands, yes, do we find optimizations that help us create more time so I can spend more time with subjectivity-driven research? For sure. At the same time, do I use it in some way that says, give me a quick update on the nuclear sector, on what some of the new laws coming out are and what some of the things coming out from the current administration are? For sure. It makes it much easier than me reading a term paper on that.
Back to the biggest companies we were just talking about, how do you think about market concentration? The market's among the most concentrated it's been, at least in history. And some people see that as a risk, and some people say, you know what, these companies are the greatest companies in the world. They deserve to be that big. It's not really that big of a risk to the market. People need these products in their everyday life. Like, how do you think about that balance and the risks of concentration overall?
I think it's going to make me sweat a little bit to tell you this, but I think this is the economy we're in currently. And I think this is the economy we're in for a long time. I look back to those historical paradigms of railroads and energy and banks that were at one point a significant portion, and telecom. Technology is it's not only the market, it's the economy now. It's the economy we're operating in. We're talking on a podcast, we're looking at video, we're deploying AI and helping us summarize areas and create efficiencies. And you can't put that genie back in the bottle, though it's a significant change. And so getting to your diversification question, well, it's the market and the economy now. So it doesn't surprise me that it is such a large component of the overall market. And we're talking upwards of 50% of the market now, because even though Meta and Google are poster childs here for not being in the tech portion of the index, they're still technology companies. And so it is significant exposure to that thematic that is artificial intelligence or accelerations in computing technology. So it is very important if the economy now, is it a lack of diversification by having Google being 6+% of the S&P 500 index? Not yet. But that said, what it gets back to as well, what do all these other companies actually do? Banks, energy companies and pipelines, consumer companies, utilities, are they going away or are they getting larger at some point? Well, they better grow commiserately. Otherwise, these large tech companies are not going to realize their return on invested capital. So at a minimum, I think we have to hit a peak at some point, and you need to see consumption come from these other areas that will benefit. So I'm kind of giving you the two-handed economist answer here. I don't think we're there yet as far as overweighting and diversification problems, but at the same time, we're going to see a broadening. Other companies will benefit. Otherwise, that return on invested, the ROIC that the tech companies won't materialize.
Yeah, I think the two-handed answer is probably the right answer at this point. It's interesting to me, like if you look historically at the biggest companies in the S&P, like the top 10, and you look decade to decade, there's usually pretty high turnover within those names. You know, companies we think can't be upended are, but I wonder a lot about if that's going to happen this time, because these companies are so dominant in the space, and they're also dominant in sort of AI, the new thing we're doing. Like, I wonder, I don't have the answer one way or another, but I wonder if like 10 years from now, these will still be the biggest companies, or if some company we haven't even thought of is going to come from behind.
This is back to that, it's almost two-handed to say, on one hand, tech is going to be a large weight for a long time. And the fact that Google, for instance, is nearly a $4 trillion company doesn't mean that that's the maximum it can be. It can be larger. But there's the other side but that constituency can change. And, I went around the investment committee the other day that we run and took a vote of who thinks one of the Mag 7 won't exist in 10 years. And nobody voted yes. But I would tell you that there's a pretty significant probability by what I just said around the existential nature of the spending. We're going to have the winners and losers still. And the winners may gain quite a lot, right? And they'll likely be in technology in 10 years' time. But we may see an existential problem with a company that you think is an absolute household name and will never go away at this point.
Yeah, when you're spending as if your life is on the line, and that's kind of what these companies are doing right now. I mean, they're expecting that they're looking at this as a winner-take-all type thing, which is interesting. I don't see it as much from the outside, but I think they do from the inside. They think there's going to be a clear winner here, and they're spending massive amounts of money. So to your point, there could be risks to some of them if they're not that winner, if that ends up being the case.
Truly. Yep.
How do you think about the broadening? You mentioned broadening of the market before, and anyone who's used a value strategy or any type of strategy like that has struggled for a long time. The average stock in the S&P 500 has struggled relative to the S&P 500 as a whole. How do you think? I feel like we've been thinking that's going to change for many, many years, and it just doesn't. Like, how do you think about that potential going forward, that we're finally going to see a broadening where maybe your average stock is doing as well as these large companies?
I think we need to see that at some point, as I said. Otherwise, that ROIC from the spend is not going to materialize. So I'm consistently looking for that, where we're going to see. It doesn't necessarily need to be a difference in multiples at this point, or I should say, it doesn't need to see necessarily multiples rise on industrial sector or consumer sector, but it does mean earnings realization from innovation and maybe a better feeling for margin capture. So that would end up with a better equity risk premium on some of these smaller companies. Get that with as well, dropping interest rates or a dropping debt interest load for some of the smaller companies. And gosh, maybe small caps finally perform as well, because it's been a difficult area. There's a lot of things that we would look at. It's not that it doesn't make sense. It's just, it's not the economy that that you traditionally think of, where small caps don't perform as well as large caps. That is unlikely to persist as we start to see innovation, consumer capture, margin expansion grow in areas that are just the magnificent seven that are still the picks and shovels. Keep in mind, they're still the ones manufacturing the stuff of the gold diggers that are going to go out and find the gold. So we're still in that age of still selling all the stuff that are headed up to the hills. There will be the winners and the losers there as well. But I do see a broadening potential for we're going to use this innovation in order to generate new revenue lines, new margin expansion, et cetera.
Picking up on the idea of growth stocks, and I don't know where I saw you talk about it, but I heard you talking somewhere about this idea of growth and duration. And one of the things a lot of us thought is if interest rates go up, it's going to punish growth stocks because they're longer duration assets. Rates are going to go up, value is going to come back. That's horrible for long duration growth stocks. And I saw you in an interview somewhere, and I forget where it was, talking about this idea that maybe that's not right. Maybe these higher rates are not punishing these long duration growth stocks like we think they are. So can you talk about that?
Yeah. Traditionally, that is the metric of, I'll just repeat it because when I grew up in investing, I bought it until I started to dig in and realized, number one, it's not working. It's not, when we see interest rates rising, we're not seeing growth stocks do worse because longer term cash flows coming in are getting discounted at a higher rate and worth less. That it just doesn't work. Maybe on a short term basis, but not on a long term. And so why might that be different? Start the question. Well, one reason it might be different is because the growth stocks, especially now, especially in this latest run that we have seen, they're really pricing more of the short term growth that we're seeing, this extraordinary capital expenditure in the next 3 to 4 to 5 years. That's what we're more pricing now, as opposed to the terminal value that would get discounted at a higher rate. So the cash flow curvature is, I suppose, different than just a straight line of when you discount a straight line cash flow curvature. So it's a notable item that I think that near-term growth that we're seeing is something that is not helping. I mean, the other thing as well is that when interest rates rise in this cycle, if we see interest rates rise significantly in the long end, it's going to come as a component of one of two things likely. One is growth. If we see an expansion in growth expectations, which if we see an expansion in growth expectations driven by technological innovation or AI or anything else that's driven, then that's not necessarily going to hurt their multiple. Even if we see interest rates go up, it's going to probably outweigh the cash flow discounting component of it. Or it'll be a component of inflation expectations rising in the long end. And then that could have a different effect. If we see that start to deteriorate the long end, then we'll start to make a distinction that actually is probably more inflation than growth. I'd have more concern there. Just don't see that yet.
Yeah, what I like about that too is often when we see these rules of thumb in investing, they're almost too easy. We think, obviously, rates are going up, it's going to penalize growth stocks. And there's so many other things like this. And if you just take them as completely literally, it doesn't end up working out that way in the real world half the time.
No, it hasn't. And it's hurt investors that have tried to play the factor game, which is it's a good game. You look for all of your vectors of alpha, if you will, and people should think that way of when growth might work and when value might work, but it just changes why it might work in each scenario. And it's less interest rate driven on the growth value side, except for 2022, where 2022 we saw that rooster come home.
Maybe that's what it was. You had that initial adjustment. And then as these companies then turned and started growing again, particularly to your first point, like the shorter term growth maybe being weighed more, those interest rates. Cause I've always been I'm still like wrestling with this. I'm going to listen back to this part carefully because I'm still kind of perplexed by this idea of the higher rates shouldn't hurt growth companies more. It's very interesting stuff.
It is, and it's surprising because it's too easy to do the math, and I've done the math a number of times and tried to figure out exactly how much a 1% bump in 10-year rates would impact the terminal value, and so depress your multiple, and the math is there, but the market's not.
Right.
Speaking of something else that struggled, international stocks, at least until this year, struggled a lot for a long period of time. And it led a lot of people to question the value of international diversification. And I'm just wondering what your take is on that. Like, First of all, just at a high level, before we talk about them now, like what are your thoughts on the benefits of international diversification? I mean, do you feel like it's a significant benefit for U.S. investors to have significant international exposure?
For sure. I think it's a great tactical tool in the toolbox, if you will. Is it always a benefit? It is not. And I mean, over the last decade, we've seen pretty significant divergence between U.S. exceptionalism and international laggards, right? So yeah, it doesn't always work for you, but it's a great tactical tool in the toolbox. The other question is, do I think U.S. exceptionalism is run its course, and we're going to start to see, whether, or at least, international stocks are simply cheap enough to start to revert relative? I don't think we're there yet. And I'm more talking about developed market international as well. I do believe that we're going to see, in a period where this coming year, we've got dropping interest rates. We've got an outgoing Fed chairman in May of 2026, with a new one that without a doubt will be more dovish than where we are now. We have the big, beautiful bill that is coming into effect, that some parts of it have already come into effect, and we're going to see those tax refunds be a significant consumer impulse coming into the new year. We're going to see different expensing laws come into effect. They're going to help corporations in the coming year. So this is not the year that I think that the catalysts are there for international developed markets to outperform. The emerging markets, I think, they've also deteriorated relative for the last decade, almost a decade. And so that's a notable item. If we see this growth, though, materialize, if we see AI and other things on the technology side start to deploy more copper lines and more optics and more areas that are manufacturing driven, we're going to see a benefit come from markets for that, and that often is going to come as a result in emerging markets. Now, China is 30% of the emerging markets index as well. And guess who we're in a race with on this technological innovation stuff? So we just saw data come out. Well, last night they come out on our Sunday night. That said growth wasn't so great there. I think we'll likely see some stimulus come to the Chinese equity markets or to the Chinese economy at some point. But over a longer term paradigm, we're in a race, and we're in a race for technology dominance. We know this, but just remember who our partner is in the 30% of the emerging market index. And I think that investors would be well served on the diversification component you asked about to have that as a part of their portfolio with the U.S. markets.
Yeah, it's interesting on the U.S. exceptionalism point. Like people tend to think these things end with a bang, and I think that's not necessarily the way it always works out. Like people think everyone's going to be pulling all their money from the U.S. and all these large foreign pools of money. You're just going to withdraw their money, and it's like there's going to be some sort of massive outperformance. And usually these things move pretty slowly back and forth. I don't know. Correct me if you don't think that's right.
Well, either that, or if they don't move slowly, it happens on both sides of the ocean.
I want to switch to the overall economy here because I was listening to another podcast you had done, and you were talking about the economy. And one of the things we've seen a lot of people, and this was not you, that we've seen talk about is this idea that we were going to have a recession for many, many years. Like thinking about starting in like 2021, everybody was calling for a recession. I think many people thought just the degree of the rate increase had to trigger a recession almost. But in these indicators, the yield curve inverted, the Somme rule triggered, all these things that usually would trigger a recession did, and we didn't get the recession. I'm wondering, do you have any take on that, and as to why maybe a lot of people got that wrong, and maybe why we didn't maybe get the recession many people thought we were going to get?
What's funny is I listened to Ed Yardini on you guys' podcast, and he was talking about some of these indicators, like the leading indicators, it's just broken. I mean, send it back to the manufacturer and try and get a refund. They're not working. The Somme rule is not working. The interest the curve rule is not working this time around, or not yet, but usually you would have predicted as such. And now we're going into an easing cycle. And right now we're going into we're in a cycle as well where corporate profits are growing and growing significantly. And since 1940, we've never seen a recession where corporate profits are growing, I would say growing year on year, but also growing at a substantial rate. So it's hard to see where the recession comes from at this point, in part because we're still seeing growing profits. We're still seeing companies that are doing well. And in part as well, because what tools do we have in the toolbox to dampen the volatility risk when it rears its ugly head? One of those is monetary policy, and it's much harder to do when interest rates are near zero, or you've got a really expanded balance sheet. And then guess what? We're not at zero. We are still at an elevated rate. We could cut rates by 300 basis points in a day if we needed to not that we would, but to suppress a big downturn. We could expand our balance sheet back out further. We've been decreasing its size in order to buy assets to provide liquidity to the market if we need to. That's helpful. It doesn't mean that we're going to avoid a downturn, but it does mean that we can at least stem the tide with the tools that we have in the toolbox from this point. And maybe we're off a recession if we start to get there where we have negative economic growth. Though I don't see it in the next year. The average probability of a recession runs about 25 to 30%, 12 months forward by various economists and by the models that we run as well. It's just how the models work out. And right now, guess what? Economists' average prognostication for a recession is at 30%. I would put it below that. I think we have enough impulse coming in the United States. I think we have enough impulse capable in the United States that is highly unlikely we're going to hit that level of a speed bump in the United States. And, the caveat, of course, being all the stuff we covered at the beginning, which is we're still pretty overladen with tech. If something happens where it's a realization that there's just not going to be the capture to justify the spending, that these companies certainly are now sitting on a bunch of debt. For those that have the debt that is going to have a much harder time of being paid off, or that we're going to see the market go a different direction, then it's large enough that would be a really big negative impact. We saw some of that at the beginning of 2025, where we saw a pretty big tech sell-off at the beginning of 2025. We saw some concerns. DeepSeek came out this year, recall, and DeepSeek suddenly, scared the market with the idea that, wait a second, maybe we don't need these super expensive NVIDIA chips, and that $4 trillion company isn't going to be worth $4 trillion, and all sorts of other things. Maybe it's just kind of a fancy hack that actually we can do to implement this. We're still going to implement this, and companies are still going to find optimal ways to deploy it and get good revenue streams and expand out their margins. It's just a matter of how much that's worth. So until we really figure that out, I think it still has high value. Back to NVIDIA has upwards of 85% market share of the AI chips deployment market. If that deteriorates and they go down to 75%, to 75% gross margin, they're still doing pretty okay. We're just not there yet.
I'm wondering too, one of the things you see in the data is we've just had less recessions, in the modern era than we did in the past. And I don't know if that's because we're getting better at managing it or if there's something else going on, but that also seems to be a factor here. We just aren't having as many recessions as we used to, which makes it hard for these people that are calling for recessions to be right about it.
Yeah, truly. That's a tough game to get in because I worry that just means the next one's going to be bigger.
It could be. Yeah, that's right.
We've often talked about things like financial excesses building in the economy. And, I'm old enough to have lived through the last couple of recessions, and on the last one where you've started to see debt rear its ugly head with shadow leverage and CDOs and CDO squareds of asset-backed securities and things that a year prior you weren't really talking about, and then suddenly they became a problem. And I'm consistently looking for where that cliff is. If there's an issue with, leverage is the constant one that we could see an unraveling there, and periodically see a little bit of an unraveling. That's less of a problem, but I am looking for the excesses that mean the next one's bigger or that they're the problem.
How about inflation? Is that something that concerns you? It's been running a little bit above target, but that doesn't seem to be a huge issue overall for the economy. Like, what are your thoughts on that?
You know what I hope? I hope that the Federal Reserve, the FOMC, looks at it as it's not that it's a huge issue, but it's equally as important as labor. And I think we have lost that a little bit. And I think even by saying that, I just probably took myself out of running for the next Fed chairman. But not that I was ever in the running.
I don't even want that job either. That's a pretty tough job.
Right. I think the idea that, because we have a dual mandate, that's labor and inflation being stable prices and full employment. I think that we have been pushing more on that full employment and saying 2.9% core PCE, 2.8, about where we are now. is fine as long as it's not moving much, even though it's above the historical 2%, what we deem as stable prices. I worry that that is still on the high side, that could lead to a consumer problem and a debt problem in the future if it gets out of control. It's too close. I would rather see it a balanced mandate. Now, where do I stand on it is your question of, do I think it's going up or down? I actually think it's probably going down. My expectation right now that, once a month I go through and I run the models that give us an outlook, and our outlook is less than the market, in part because as you've heard, I believe in this technological innovation. And if I believe in that technological innovation impacting companies and providing new revenue streams, then it's highly possible that technological innovation is going to be a disinflationary force. So I believe we'll likely see lower inflation, but I hope that the Fed does still think of, even if we see lower inflation, 2.7%, core PCE, one of their chosen metrics, is still above their mandate. And I want them to be cautious as a respect.
As someone who manages large pools of capital, how do you think about this macro stuff? Like, on one hand, it's very, very difficult to predict. And, as you pointed out, like, economists have no idea where the economy is going. But on the other hand, this certainly affects, the investments you're investing in different ways. If inflation's to spike, or if we have a recession or things like that. So how do you think about that balance between, like, this is very difficult to predict, but I also have to take this into consideration when I'm making decisions?
It's tough. When you actually do attribution models of performance on portfolios, there's no doubt that it's something like 70% of your attribution is driven by macro forces. That doesn't mean that everybody becomes a macro investor. That means that either you have some areas where you think you have insight and you can produce outsized returns by finding asymmetric risk reward, or an insight that is a deployable, investable insight, or you insulate away some of those conditions, which also means you need to know the macro environment. You need to know some of the major catalysts out there and the timings of those catalysts in order to insulate away from things you just don't know. Geopolitical risk, I generally think of, I have no idea what's happening in the back rooms with people smoking cigars and talking about, what piece of territory is going to go where, or that it doesn't. I mean, it's great to read the paper and think about it, but it's more something that I want to insulate against, as opposed to try and understand which way it's going to happen in a geopolitical force. I can know when geopolitical risk is increasing, and when I want to be more insulated away from it. That's how I use that information primarily. If I look at the Federal Reserve, or if I look at the U.S. economy, those are economic forces which are just the contemporaneous forces. You break it out into trailing indicators, contemporaneous indicators, and leading indicators, and we have a pretty good idea of which are which fall into which bucket, and we can use that to help drive sector performance, or factor performance, or quality performance. Because, as I said earlier, you want to use all of these vectors, not just the fundamental, does this company generate enough income, and is it going to be above the consensus, but are they going to be increasingly benefited by what we're seeing as the leading indicator, giving us the tailwinds of the economy. So I use that information where I can, and where I feel like we have an understandable, investable bias. But there are other areas where I just use it to insulate away from risk that I don't want.
Just one more on the Fed, because you referred to what the situation they're in, and it's a pretty challenging situation. Like, how do you think about what they're doing right now? I mean, the fact that they are cutting right now, it seems like maybe you're thinking they're not thinking enough about inflation when they're doing that. But how do you think about that balance they're in right now?
I think it's there's a lot of chatter right now about whether the Fed and their balance is kind of lost its way, and there's a loss of independence as a result. This last one, we had 3 dissenters on the Fed. We have a pretty wide band of the actual voting bloc that is going one way or the other, with Governor Moran saying we should be cutting by 50 basis points, and then 2 of the governors saying that we shouldn't be cutting at all. So there's still independence in thought. We may see a push towards more of a dovish bias on the committee as a whole. And I think we will see that. Certainly we're going to see that when we get a new governor appointed, a new chairman appointed in mid-2026, probably before. As soon as it's announced, we'll start to price that in. But what I think about it, I think it's still independent. I think this is not that different from any other political administration we've been in. I'm going to test that. It is a little bit different and stronger-handed. But I don't think that there's a secular change in how the Fed is going to operate. And I have hopes for the Fed. I hope that they keep to our dual mandate and not preference one side versus the other. But at the same time, if we start to see that, that becomes an investable thesis for me. And we are seeing a little bit of that. We're seeing even just in that you're asking about it, well, does inflation, not that it matters anymore, but is 2.9% the new 2, or 3% the new 2%, as some would say. I don't think that, but I do think that easing is the new neutral. And by easing as a new neutral, I mean, we're pushing more on the labor mandate. We want the labor market to be really healthy and as healthy as possible, part because of the voting block, and we're pushing more on that. In part because we do see some negative metrics coming out of the labor market, and we have concerns around technological innovation that could impact that, though. But that's a growth-oriented indicator, labor, versus inflation, which is an overheating indicator. So what do I think about the Fed? I think easing is a new neutral. I think it's in an easing mode, and I think that's for at least the next year to come, if not longer.
Sort of stepping out of equities a little bit, I wanted to ask you about the 60-40 portfolio. So the 60-40 had like a great 35, 40-year run up until 2022. And then, both because of, as you mentioned earlier, the Fed was aggressively raising rates. So bonds obviously got hit very hard. And then, equities went down as well. And so it woke a lot of investors up to that while the 60-40 had done very well, and it's certainly a decent strategy, but there is kind of this weakness to it. And, just generally, how do you think investors sort of need to be thinking about going beyond the 60-40? And I guess if so, what other asset classes would you start to be looking at in there?
I think it's clear with my bias that the standard 60-40, hold it at 60-40, watch it at 60-40, and retire with it 60-40 is not going to produce your best outcome. Being tactical and understanding, even whether if tactical, whatever time period means 1 year or 3 years or 5 years, in terms of making changes to that paradigm, is very important for value capture that's going to compound over a longer term. And the constituency of 60-40, when we talk 60-40, of course, we're talking 60% equities and 40% bonds. Well, there's more liquid markets that have come out in a number of areas that make sense for people to be involved in. One of those would be convertible bonds. So that's not just bond, but at least being creative around your public equities and your public oriented bonds that you're invested in. And I think increasingly the investors that have that 60-40 should be thinking that it should include some element of a private captured. So not just set it at 60-40 and do that when you're 30 years old and wake up when you're 60 and retire on that. For whoever retires when they're 60, not me. But that's a changed paradigm now, and we're seeing so much more value creation in the private sphere. We're seeing so many companies now in the private sphere that are, if they were public, they'd be mid-cap or even large cap securities. I mean, take Tesla, and so not Tesla, take SpaceX. Actually, no, just think Elon Musk generally. But these are extraordinary value capture that are still private and still in the private capital, because there is a lot of private capital there. That's an investable area that 60-40 investors should be thinking about. And we have a fund that's our Income Opportunity Fund, where we aim to take advantage of that where we can. And I think it's reasonably distinctive how we're looking at it. In our equity book, this is a great addition. If we can find good value capture with good transparency, oftentimes we have more transparency on a private than we do on a public, because you're having direct access to the management team. And just go broadly, people should be looking at where you're going to see the opportunity lie there. When that comes to market, you have less of the value capture. So if you can find a good mid-cap company that's producing cash flow that is in any stage of its life that you like, that should be an opportunity, not just a private sphere. So going back to your 60-40, 60-40 is a proverbial number that over a long term probably is still about right. I would probably say it's slated over the long haul to be a better capitalization with less bonds. But from where we stand now, it's important for investors to look at some time period for which they change that matrix or really just add a tactical lever to it, but also understanding that private capital is increasingly melding with public capital and should be a part of that consideration.
I think one of the things that, like, when you're talking about like a tactical lever, like how would you, for a retail investor, is that leaning into maybe where there might be more value? To your point about international earlier, I'm just trying to sort of shake out like what levers realistically, because, a lot of our listeners aren't necessarily, they're not, it's not their day job to trade their portfolios, but I think they would be interested in hearing about what types of levers a firm like Westwood looks at when making those tactical adjustments.
Sure. And so when I think about tactical levers, I mean, we are looking at we talked about leading indicators and trailing indicators and contemporaneous indicators. We're using, I'd say, more fundamental of looking at the universe at large to say, what are the winds of change and how we're going to capture those winds of change? And they may not be technical indicators that say, we just hit the 200-day moving average. That's less of the kind of thing that we're looking at versus looking at the environment and what is going to perform in an environment where interest rates are dropping and easing is the new neutral, and we see jobs as a concern. Those kinds of things are going to help drive returns. And as I said, this is a multi-year kind of time frame. So we're looking at multi-year movements around moving the deck chairs around a little bit, if you will. We talked about emerging markets. That's a tactical move as well. We haven't held emerging markets now where we are, in part because we've seen U.S. exceptionalism and we've seen the aggregate of the growth of the mega caps in the United States, and that being a big part. But as we see that expansion out, as we see that ecosystem start to mature as well, it's going to lead to value capture across different parts of the ecosystem that as an investor, you want to be able to take advantage of. So that leads to either sector biases or factor biases. I mean, there are times we talked a lot about valuation at the front end of this podcast, and valuation is stretched right now relative to history. No matter how you slice and dice it, it's we're sliced very high as price to earnings or price to cash flow or including price to sales. It's hard to get away from that rubber band not coming back a little bit. So just investing to understand that there's less potential upside in this market, so your symmetry is different, is very important. And if you're a 60-40 investor, you're invested across asset classes as well. And we're in an environment right now where as stretched as equities are, you can double down on that for corporate bonds. You're not getting paid for default risk right now where you are in corporate bonds broadly. There's still some opportunities, but broadly not near as much as a symmetric equity. And so the tactical investment would say, now is not the time to be 60-40. Now is the time to hold more equities, potentially more conservative equities with less of the fixed income risk.
You guys just launched the Enhanced Income Opportunity ETF. You had mentioned that earlier. The ticker symbol is YLBW. It was just launched actually a few days ago. So it's relatively new and out of the gate, I don't know for sure. Jack might know a little bit more than me, but I mean, I don't think I've seen many other ETFs that are doing what you're doing here. So it's a combination. It's really a multi-asset sort of strategy with this cover call overlay on, I guess, the equities, right? So just talk about what this strategy is intended to do, what it is doing, what's it intended to do, and like what is the investment process behind this new ETF?
Sure, and thanks for asking. We're really excited about this. Now, we don't see others doing this as well. We see just enough that there's a true investor need for this product, something that, as we look at our biases being trying to capture the capital appreciation available in the market to us, provide good income and provide downside capture, this really centers in on that, and it focuses on that income variant as being something that you can count on. And you know what else it does? It shortens up your interest rate duration. It actually reduces risk in two ways. Number one, it reduces your overall equity risk. But number two, you get better income with less interest rate duration. Those cash flows that you get, you either reinvest at a good level, you redeploy as if you were just having 3-month bills that were rolling off, or you take and you go buy a fancy red car. We don't mind what you decide to do. But the idea is that it reduces your risk in more ways than just with having a straight bond and equity portfolio, provides great cash flows. Right. And at the same time, our equity selection is very important as well. Covered calls, adding covered calls is something that others do. We're doing it in an active way where we're going out and we're selecting securities that we think provide great capital appreciation potential. We're generating off of that. Gosh, where else do you get paid to set a price target? That's effectively what we are doing when we're doing covered calls on this portfolio. That's an active manner. We're getting paid to set a price target. That's what's important about this. It is a diversified portfolio that is a 60-40 like balanced portfolio that's tactical. We're looking at the winds of change in the economy. We're looking at different asset classes that might benefit us. And we're generating exceptional amounts of income on the back of that also reduce the risk in the way we generate the income. Number one, we're doing it in securities we feel have a good potential for appreciation. And number two, that income is actually shorter in duration because we're doing it on the options roll. We're not doing it with a long-term capital appreciation potential that could get discounted out as rates go up. So it's a notable way that we're doing it. The process for us it does add to our process. It's a standard process we've run for decades of selecting securities and setting fundamental price targets and finding the best opportunities we can that have a best risk reward for individual securities, pricing out on fixed income the amount of appropriate default risk or that spread that investors should receive. We still do all of that. There's also the added dimension now of looking at what companies as well provide us with the best income, looking at the implied volatility. There are companies that just before their earnings profile, I won't say their name, but they're above $4 trillion in market cap. So kind of hard to miss which one, has extraordinary volatility just before earnings. And investors have the capability of taking advantage of that to their benefit for income because NVIDIA goes up and down pretty significantly around earnings at times. As an investable paradigm, if we like a name, we could take advantage of the name plus additional income. So it gives us one more vector of analysis in our process.
No, it's really interesting. I think distinctive strategy. Let me ask you. So, and by the way, investors can go and see the funds, like, the fund page online. But what you can always do with ETFs is download the holding list. And then, you can kind of take that and say, okay, now I'm kind of seeing visually what kind of stocks they're buying and, what kind of corporate bond. But this is more of a question for me. Like when you're showing your bond position, you have an HPQ bond in here. And this isn't an individual recommendation from me or you, Adrian, but when you have that position and then it says, after that, it says 6.1, and then it gives a date like April 25th, 2035. Is that 6.1 the actual annual coupon that the bond
That's a great question. That is the annual coupon. Yes.
Okay.
That doesn't mean that's the yield to worst over the lifetime of that bond.
Yeah.
But that is the distributed coupon that it pays. It borrowed at some point in its life, and it will keep paying that up until 2035, we hope, lest it defaults or find some other way to take it out. But it will pay that 6.1%. But if HPQ suddenly becomes a really risky company, then the next time they borrow, they're going to borrow with an 8% coupon. That bond will trade it at discount.
Okay.
They'll still pay a 6.1% coupon.
Yeah. So certainly encourage those listening to go check out the ETF and look at, what they're doing here, because it is pretty unique and cool. Okay. So we always like to ask our investors a standard closing question. You've been on us once before. So, but we do have a new one for you. And that question is, what is the one thing you believe about investing that the majority of your peers would disagree with you with?
I'd probably say, I'll reach this probably a lot of areas. One of them would be that price discovery, that the inefficiencies around price discovery and the opportunities that exist are only going to increase as a result of all this technological innovation that we're discussing. That those that, deploying AI, we're all deploying AI, and those that don't we're going to separate out between the analysts and the analysts that know which questions to ask. It's not going to take out the analyst pool. It's going to assist those that know how to ask the questions. And as I said about the potential trading paradigm that is just purely technical, using that information, bring them on. That's where the human subjectivity is really going to help us. I see price discovery is going to increase and opportunities increase as analysts that know how to ask the right questions, use it to their benefit, but still very much so use their subjectivity, find opportunities. And whether that's this tactical orientation of reading the winds of change and finding how to move your factors, your quality, your asset classes, your sectors around, or whether it's on an individual company, it doesn't matter. I believe we're going to see greater inefficiency as opposed to less.
Great. Thank you very much, Adrian. Really appreciate it, and wishing you and yours happy holidays. Thank you.
Likewise. Thank you both.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.